Welcome to the Everything Apartments podcast. I'm your host, Eric Christopher. I'm president of WSC Realty Advisors here in Long Beach, California, where I've been an apartment broker, owner, and property manager for the last 15 years. This podcast covers all aspects of multifamily investments, from buying and financing properties. We also cover the day-to-day operations and management and into reinvestment strategies to increase your net worth. We have a great show with a great guest today, so let's get right into it. Certainly, taxes are something that loom over every single one of us ever since you turned 18, frankly, and it looms much heavier when we get into business. We begin buying assets, our net worth's increasing, our tax base is increased, basically. It's really become apparent that the government, vis-a-vis being in business or owning rental property, is really just a vehicle to shake us all down. And obviously, taxation is a kind of a hub to that. So guessing most of us have some frame of reference with taxes. I mean, I was sharing with our guest, it's probably something like myself that's really hot on our minds for about maybe 2 or 3 months a year. I'm certain for most it would be a great advantage to learn a little more. Not that we're going to be a tax professional or we're going to think about this stuff all day, but it might not be a bad idea to have some of it in the, let's say, in the side of your mind, so that when you've got a decision coming up that might ring out to something you heard here or what you read, that you can navigate through in a little more productive and better way for yourself. So today we have with us Tony Watson of the tax consulting firm Robert Hall and Associates here in Glendale, California. Tony's an enrolled agent, and we'll get to that in a minute because I didn't exactly know what that was until I looked it up. But he specializes in tax issues, among other things, real estate investors, small business, entrepreneurs, startups. And that sounds like a crowd that we're talking to here. And we'll perhaps gain some ideas, tips, and tricks, just a little more than we have now, to try to navigate some of this stuff and keep it around in our minds making decisions. Tony, thanks for being with us today.
Yeah, thank you so much, Eric. Thanks everyone for listening in. I'm very, very excited to be here.
Yeah, this is a topic that I think is definitely, it's always timely, but it's for many of us, and I can just tell this, it's sort of like a gray unknown cloud like that you've got in your mind, and it's coming around once a year, and you've got to deal with it. And so maybe you can kind of maybe part that cloud a little bit for us on a few of the items. Now, I saw Chapman College, and that's if you don't know that school, it's a very highly reveled business school, or it's a college of different disciplines, but the business school is very highly reveled here in Orange County. It's not a terribly large school, but it's got a great reputation, and always interest perks up because I've had friends and maybe a few family members that went there. How did you pick Chapman, just off the top of your head, Tony?
I had a good friend of mine from high school that I had met just over a summer break. And I had originally spent my first year to a year and a half playing baseball up in Central California. And I realized very quickly that I wanted to be more serious with the business world rather than trying my shot at the big leagues. So when I decided to move out of the baseball frenzy, so to speak, I met with this friend, and he said, "Hey, come check out Chapman." When I went there, it was a lot smaller of a campus than it is now. They have a beautiful football stadium now, and they've revamped there and built onto their old law school as well. So I went and visited, fell in love with it, fell in love with the smaller classrooms, class sizes, I think max. I had one hall, one class in a hall with about 200 students, but a majority of my classes, 90% of my classes were 40 students. And you really got to know, one of the going on jokes on campus was it was called Chapman High, not Chapman University. So you got really acquainted with the campus and the teachers. And I felt like it was much more of a personal one-on-one conversation with teachers rather than being lost in the numbers. So I fell in love with it and spent the rest of my years at school there. And a week after I graduated, moved to LA and hit the ground running in my career as a tax advisor.
That's awesome, and we'll jump right into that. But you probably enjoyed a few days at the Orange Street Fair back in the college era.
Very much so. Old Town Orange is a special place. I hold it near and dear to my heart. Lots of beers, drank and spilled in the Old Town Circle, bagels and coffee in the morning, and a lot of the antique shops. But yeah, a walking distance from that Old Town area. Just really special place.
Yeah, definitely kind of a throwback from the past. You don't see a lot of those anymore in just the pristine condition that it is. But okay, so you already jumped ahead, which is great because I love to hear people's travels from, let's say, where they went to college and then how they wound up where they are today. So it sounds like you got out and you went straight into the industry you're in now.
Yes, yes. My long story short, my brother had been working for Robert Hall and Associates for a little bit over a year and a half, 2 years. And when I graduated, my brother and I are very close, and we still continue to work with each other for the past 17 years that I've been at Robert Hall. And I saw him doing very well. I saw him learning a lot, and it really helped him out with his own business investments, with our family real estate investments. And I said, hey, what do you think about me coming to work? I mean, you like it there? You like, like learning the topics of taxation and how it's helped you? And he said, come try it out. It's not for everybody, but come try it out. And here I am 17 years later and loving every second of it.
That's absolutely really cool. I mean, you hear people that have maybe, bounced around a little bit, or maybe it's a second generation where dad had a practice or something, and you may have just jumped into it without thinking. But that's really cool that you had a brother and had a chance to just check it out without a lot of commitment if you didn't like it, right?
Yep.
So
Very much so.
the enrolled agent thing, I've heard that term a million and one times. I thought, man, I better look this up before I look like an idiot when I get online with this guy. But tell me a little more about that, because that seems like it's a bit of a strenuous process to achieve, so that you can then go and communicate directly with the IRS. Or tell me a little more about that.
Yes. So in college, I always struggled with either the business direction or going into law school after I graduated. And as much as I loved the Chapman campus, I was more interested in getting out of school and starting to make money. And just like most young-minded individuals, and so I moved to LA, the mecca of business in my mind. And when I entered into the accounting field. What I learned very quickly is most people are more familiar with the CPA title, and CPAs and EAs, they do a lot of the same things when it comes to taxes. But even if you asked a CPA, a licensed CPA, which title was more real estate specific, or not real estate specific, but tax specific, most CPAs would say, well, an EA is more income tax, more of an income tax professional, whereas a CPA usually will handle maybe your taxes, but they'll do the balancing of your books and issuing payroll and cutting checks for you, kind of like a CFO position for your business. Whereas an enrolled agent holds a federal license. So unlike a CPA that usually is licensed in the state that they practice, an EA holds a federal license, and we can prepare taxes in all 50 states across the US, but we are tax specific. Our firm has bookkeepers and we have payroll specialists and such, but myself and all of the senior enrolled agents, senior accountants at our firm, we are income tax professionals. So if you have very complicated income tax questions, 1031 exchanges, cost segregation, end of life tax planning, those types of things, more likely than not, you'll get more bang for your buck talking with an enrolled agent. Not to talk down on CPAs, we very much work in the same industry, but enrolled agents are more of a federally licensed income tax specialist, licensed individual.
I'm glad you clarified that for me, because like I said, I heard the term a million times and didn't know what it meant. And I had a need just a short time ago where if I'd known what it was and had already had this recording with you, I could have sent them over. But now that's great to know, because I'm an accountant in my past life. I'm not a CPA. I was what you call like a managerial accountant, a bookkeeper that kind of graduated up in a career a little bit and just didn't see the track for me to do the CPA thing, but have always had a lot of respect for that. And they are the normal, what you think of an accountant and taxes. I think most people just think CPA and may not have understood the EA side of it. So that's great to point out.
Right. Yeah.
Excellent. So first and foremost, I think right now on everybody's mind, and I don't know about you, in my career of 15 years, I've heard the 1031 exchange mechanism come under fire probably 2 or 3 times where it would make the news. And then it would obviously kind of dissipate after a short period of time. I would say I'm more concerned now based on who I see behind it, as far as Eat the Rich or, Robin Hood. And what are your thoughts on what that looks like moving forward from here?
Sure. So over the past, actually, like you said, you've seen this under fire before under different administrations, and currently where we're at right now, President Biden's administration has released a green book on what the potential changes are. As of today's date, nothing has been finalized, nothing's been set in stone, and so first and foremost, I want to make sure that everybody listening, and I tell this to my clients all the time, that until it's set in stone, and I've learned this from my boss as well, unless it's in writing, it doesn't exist, right? Well, the Green Book exists, but nothing is actually set in stone yet. So to jump the gun and actually start an exchange process or to liquidate assets solely based on speculation at the moment would not be the right approach. Right now, what I've read individually under the Green Book is that the exchange industry isn't just going to up and disappear overnight. I mean, let's face it, the exchange industry employs over 600,000 employees nationwide. And we're talking about US transactions, foreign transactions, not for each other. You can exchange foreign for foreign or US for US, but not US for foreign or foreign for US. So you're talking about an industry that creates hundreds and hundreds of thousands of jobs and billions of dollars in revenue across the US. And remember, we're talking about 600,000 employed jobs in the exchange industry. That doesn't include all of the people who get paid on the front end and the back end of an exchange transaction. So for the government to just delete essentially a full industry like that, it was impossible for them to do that. And it was improbable for them to do that. Now, what they've been talking about is limiting the amount that you can exchange, and also talking about income thresholds that people will qualify for that type of exchange. And so once those figures are really dialed in, we'll have a better understanding of who actually will qualify for the exchange under the new administration. However, remember that every 4 to 8 years, we have a new president, we have new legislation. So we've seen things disappear, we've seen things come back. Some benefits phase in, some benefits phase back out. So that ebb and flow that the government does with the Internal Revenue Code will continue. And if they get rid of or limit part of the exchange industry, there's very much a possibility that it will come back in future years. So that's why, when people talk about doing really rash and drastic and immediate things with their finances because of a new legislation or a new bill being passed, you always have to remember that might change for a little bit, but it very much might be back in play, in 4, 8, 10 years from now. One thing that I've always known about real estate is that real estate should, for the most part, always be a long-term investment. I'm not going to argue with my clients about it, but we want buy and hold. Buy and hold is really how you grow exponential wealth in the real estate industry. So, and that's the one thing I want people to focus on, is that an industry that creates that many jobs here in the United States of America and benefits the U.S. economy as much as it does, I don't think it'll ever go away. It will be fine-tuned, there will be limitations, and then it's all about taking a step back and figuring out ways for it to benefit you still, even under the new administration and the new limitations.
Yeah, it was interesting. Just this morning, I knew I was going to be speaking with you today, and I forget, it was maybe CoStar or one or the other. They had a New York Times article about the whole topic, and Ernst & Young did a projection, or at least an estimate, that the Section 1031 could support as many as 710,000 jobs that generate labor income of up to $34.5 billion a year.
There you go.
And one of the things that interests me, because, obviously we grew up in the same neck of the woods, and it was sort of our World War II, let's say post-World War II era. You buy a piece of property in Southern California and you'd never lose, right? You could buy it at the wrong time and just hold on to it, and eventually it's going to correct and you're going to have some nice returns on it. And I keep asking people, like, if you throw rent control in an apartment owner, does that make him want to spend money on his building or not spend money on his building? If you take away a 1031 exchange mechanism, is that going to make him want to spend money on his building or not spend money on his building? And I've got this kind of curiosity about, if through let's say our kids' generation, we get out and now our kids are in their 30s and 40s, are they going to experience the same almost parabolic uptrend over a long period of time? Obviously, we have our dips. Are they going to experience the same type of uptrend that we and our parents have? And sometimes I think, wow, they keep adding on these rocks that we've got to pull behind us, or taking away things. Now, luckily, your point is well taken, that the next administration could unwind and rebuild whatever it is, but then would it come back with all of the same bells and whistles that we have now, or would it be a modified version? So it's like that fear of the unknown that gets me a little concerned. But now let me ask you this: let's say this thing moves forward, any idea if it does happen, is there a window like it would take effect? I'm trying to figure out if myself, for example, or another owner listening to this that was thinking about doing a 1031, but their motivation wasn't quite there, will there be a window for them to act, or will it just hit in one day, do you think?
So normally there are timeframes to put in play certain transactions and to qualify for the benefit of the deferral of the the capital gain tax. There are a couple outside factors that also need to be involved in the calculation. One, right now the market is at somewhat of an all-time high. I don't think anybody could disagree with that. Interest rates are super low. It's creating a buying frenzy. So, even if the government did make that initial start date January 1st of 2022, where the limitations were set in place on the 1031 exchange, you're still really wanting to take into account more than just the deadlines, more than just the dates that because if you sell within the next 3 to 4 months, I don't know how long interest rates will stay as low as they are, but if you sell within the next 3 to 4 months, let's say, or before the end of 2021, for a fact you're locking in probably what's going to be the peak number for value of property before the next correction hits. And let's face it, every 12, 13, maybe even 14 years on the long end, we go through this cyclical adjustment in the real estate industry. We've seen it historically, dating back as long as data numbers have been available in real estate valuations. We've seen that cyclical period happen where the market ebbs and flows and people will buy, obviously buy low, sell high. That's the goal. And a lot of people can sell right now and take advantage of certain benefits outside of the 1031 exchange industry, especially if they're living in the home they lived in it 2 out of the past 5 years. That's part of Section 121 of the Internal Revenue Code. We can exclude $250,000 to upwards of $500,000 in capital gain from your taxable income if you've lived in the property for a certain period of time. So there are some maneuvers that people can make with their even rental properties, where if they need to move into the property because of economic hardship or significant change in something in their life that warrants them having to move out of their current place that they're living and into one of their rental properties, they might not need the 1031 exchange. So getting back to your question, if the government does implement that change, what they talked about towards the beginning of this year is implementing it as of the start of 2022, which normally that's how the transition happens. But right now we don't have a final tax code. So they're still trying to determine when this will go into effect and if it's going to phase in or phase out over a certain period of time. I believe that it will probably go into effect. Me personally, I think that once the dust settles, it will go into effect January 1st of 2022. If we're lucky, they'll push it off till 2023, giving taxpayers an additional year to go ahead and enter into exchanges. But there's always that time frame, right? So one client was talking about doing a 1031 exchange towards the end of the year. It still is 6 months before they have to cycle that money back into another property, which gives them out until summer of 2022, if that date does get locked in closer to the beginning of 2022.
Yeah, interesting stuff, because we've relied, obviously the whole industry's always had that in the back of their mind, and that's how we're going to keep moving forward. And be interesting dynamic. You've got some great ideas that not all property owners need that, right? You've got a different scenario for every person that might darken your doorway, but it's just been such a long-standing, widely used, popular thing is the article, and we've all have stories about successes around those that it'll be interesting to see what happens next.
Yep. Well, and outside of just the exchange topic, you have the ability, and these are probably much different turn in topic, but you have the ability to put money into Delaware statutory trusts, invest in opportunity funds or opportunity zones. There are some other tricks of the trade that the general public might not know about, but if you deal in an industry like in our with our firm, we deal with normally high net worth real estate investors. We have we have over 16,000 tax returns that we service on a year-to-year basis. So we see a lot. And so when you start to do taxes for individuals with adjusted gross income, not taxable income, but with adjusted gross income north of 500 to 700 plus $1,000, you start to see the games that they can play with their their wealth managers and their financial advisors, certain programs that, because they're qualified investors, literally they have a liquidity of over $1 million, doors open for individuals in higher income brackets. I think that the general public does know that, and that's why they tend to dislike corporate America and whatnot. But the exchange side of things is just one vehicle that most people know about because it's a more common vehicle to defer tax. But when that starts to be limited, normally what happens, historically speaking, with the IRS is that when one door closes, another door opens. Now, we don't have case study on anything for 2022 yet because 2022 is the future year. But once that code is set in place, it's really not the headline topics that you focus on. It's the detail in the code. And as 2022 progresses and we enter into 2023, all tax advisors who really enjoy learning case study will find those other opened doors under the new tax code. So I wouldn't fear the change as much as everybody, because the whispering amongst the general public usually instills fear in what is changing. Because like you said, we always fear what we don't know. And so once that change does happen, your tax advisors and us at Robert Hall and Associates, we dive into that new tax code and look at the small print in the code and figure out ways that we can utilize that code to benefit our clients in certain income brackets. And obviously the goal is to make sure that clients pay, in theory, clients always want to pay less tax, but that's not always the main focus that you should be on. Your focus should be, how do I utilize the code to my benefit to pay my obligation in tax, right? Because we all pay some sort of tax when we file our returns, but when we pay our obligation, that means that we've maximized the money in our pocket over a 12-month period, over that calendar year, and we've been able to retain most of the wealth that we built ourselves. So I always tell clients that you can't think of spending for your business or your rental property as just frivolously spending. You have to think of it as reinvesting into your investment. When you file your tax return and you're trying to structure in ways to save tax, it's actually not to pay less tax, it's to retain wealth. So I like talking in a different way to my clients to get them excited about learning things. And I think right before we started the podcast, you and I had chatted about, what are some of the fears of people and what are some of the biggest misconceptions of how they should be operating their business. One thing that I always tell my clients is that the first and foremost important thing you should put in your calendar is year-end planning. And so, once again, I think this year is going to be a very unique year because with all the changes on the horizon, I think that our year-end planning, the last 3 months of the year, will be even busier than tax season will be. And so that's one thing that I did want to mention before I forget today.
No, you bring up an interesting perspective because obviously, when let's say we're just pure real estate investors, the 1031 exchange is our holy grail of how we move forward. When we talk to a guy like you, from what I'm hearing is, okay, you got a goal in mind. This particular avenue to achieve that goal may not be the same as it was, but there are other avenues that you can probably achieve all, or if not close to all of what you wanted to do at a similar disposition.
Correct.
So that's great to hear. I mean, and then the idea that you got to go out and rush to do a 1031 now. Oh, hurry up, it's going to be here. And I like your perspective there that, hey, look, there's a reason to do a 1031 exchange, but if you're rushed to do it, it's probably not there, right? So and you know what, you bring up a good point because I've got clients that they're just value add flip guy. That's a business model, right? That's a business model that with rent control can get tougher, and with the 1031 changing could get tougher. But I've always kind of preached the same thing. It's like, you're buying real estate to achieve a stream of cash flows is your primary goal. And then over a period of time, if you're buying and selling in the right frames of time, you're going to do well at that side of it too. But I don't think most people are actually skilled enough to put that as their front end goal of, like, let's just buy and sell. I mean, that's a whole business of itself. So, a lot of times I think, especially when we go through like a long-term uptrend, I call it 2011, for sure 2012, that we all just sort of get drunk on this appreciation. just like the market does. And we all do forget that there is always going to be a correction, like you're saying, 13 years or so on the far end. And we're coming right up to that
Yep.
timeline.
Yep. I think that what kind of expedited that happening was the pandemic. No one saw that coming, and that really, I think, expedited that whole cycle to be accelerated, and probably realized a little bit sooner. But then when the Feds, they locked the interest rates, and people, kind of created this buying frenzy because people can borrow money for under 3% right now. That kind of held the real estate market not stable. Actually, I think that real estate did pretty darn well over the past year overall, except for the long-term holders, right? I mean, when people weren't paying rent, that was always a big fear, and we were waiting to see if there was any relief fund for that. And there are many relief funds out there for landlords who weren't able to collect rent during the pandemic. We're still waiting to hear, the end results of the eviction process and when you could start evicting tenants. And what I've read so far is kind of towards the end of the year. But with the relief plan, I mean, the government and the state is planning on replenishing a lot of that unpaid rent. My fear is not in that. And, the devil is always in the details. How is this money going to be paid back? Right. So now you look at these changes where Biden is talking about, with the exchange only allowing $500,000 of capital gain to be exchanged possibly, and nothing above that. And the greatest fear is that if that goes into play, I mean, the appreciation over the past 10, 15 years alone on certain property, plus the add back of depreciation upon sale, the gain could be much more sizable than 500,000 on a majority of properties if they don't or aren't able to exchange properties. So, like I said, the devil is always in the details. I'm not really looking at the relief plans or anything that's going out right now. Obviously, I want to send that information to my clients, but it's how is this money going to be paid back? And how is that going to impact not only high income earners, but also middle America, because most people in, Birmingham, Alabama, if you're making 100 grand in Birmingham, Alabama, you might be living the same kind of quality of life, financially speaking, as somebody here in California making $300,000+ a year. So how is it going to affect the U.S. as a whole? California, we tend to have higher pay rates. We tend to have higher real estate values. So California will go through its own kind of trials and tribulations. But I look at it from an economy standpoint, from all 50 states, because let's face it, Californians do make money off of investments elsewhere in the U.S. as well, and vice versa. So that's really going to be my continuing fear, so to speak, is how is this money going to be paid back? Who are they going to hit to get this money back? Is it the 1031 exchange changes? Is it the increased brackets? Is it the corporate tax rate going back up from 21% to 35% plus? I mean, who knows, right? This is where we're waiting for the dust to settle around this new tax administration.
I mean, isn't it just going to be anywhere and everywhere, especially in California, right? Like, I mean, I don't know if you've been doing any reading about these public pension funds, but I got a little bit of a concern with like a fair share of high net worth individuals. And I always use Elon Musk as the biggest visible example, but there's got to be hundreds like him that obviously don't make as much, but that when they band together, they move the needle on our tax base. And if they're going to Tennessee and Texas and Florida,
Mm-hmm.
who's making up that general ledger balance?
Right.
And
Right.
I've always just thought, the easiest targets are people that own real estate, and a lot of it. And
Right.
that's, that's been the federal side of it, because you're way more involved with the tax code. I just was really sort of, indifferent toward politics before I had the time to watch what's going on from more just the state and local level. And I'm going like, holy crap, what in the world these guys they want people to move? They want people to 1031 exchange over to Arizona and over to Texas. And sometimes it feels that way, but I feel like the more net worth you have in California, the bigger target you have on your back from the government. I mean, so, I always feel like I'm getting too negative when I talk about this stuff, but I hear it from everybody. I don't think anybody disagrees that, somebody's going to have to pay that tab at some point.
Mm-hmm.
And the public pension fundees, our friends that work for the government, they may feel a little bit of that too at some point.
right?
You know?
Well, it's reality, and sometimes it's hard to look at things in a realistic light, but you simple economics, when money isn't being collected by the federal government, changes to the tax code happen. I've told clients this in webinars and seminars that the IRS is the largest collections agency, privately owned collections agency by the government, right? Not you can't buy stock in the IRS, otherwise I'd be probably the first investor. It's privately owned by the government, and they're there to do one thing and one thing only. It's to collect tax from the United States taxpayer. Now, when you compare the United States taxation system to elsewhere in the world, you can find a lot of benefits under the Internal Revenue Code compared to other countries. But we don't have the same infrastructure as Europe. We don't have the same infrastructure as South America. We don't have the same infrastructure as the rest of the world. That's what makes us the United States of America. And so when people hit the ground running and they start to really make their first couple big paydays, the thing that they tend to forget is that Uncle Sam's going to come knocking on their door at the end of the year. And if they haven't set aside some of that profit, unless they've reinvested all of their profit back into infrastructure, sure, they wipe out their profit, they pay no tax as self-employed individuals. But at the end of the day, if they go out and they buy all the luxury items, and let's say they take some of their self-employed profit and buy real estate, sure, there might be slight adjustments here and there, but once again, it kind of comes back to the importance of that planning session, that year-end planning session. We just need to make sure that whatever you make during the calendar year, whatever you purchase asset-wise, whatever you're going to do, sell, acquire, that at the end of the day, once we consolidate all of those investments, that you are keeping as much of that money in your pocket and only paying, once again, the obligated tax after all of the ordinary, necessary, and legitimate adjustments are made to the bottom line.
Yeah, that's probably another little hint that you gave me that I may not have thought about, and maybe a lot of others haven't, is, hey, take a little time in the fourth quarter rather than waiting until February or March to worry about what you're going to file for the previous year. Get out ahead of it a couple of months, especially if you've seen yourself succeed in a larger way than you have before. That's a great point. And then just as a sidebar, I'll have your contact information and everything in the show notes. I'll whisper out your website on the way out, but that I'm learning something new as well. Let's switch gears here so that we don't kill the day. But we were talking a little earlier, pretty much everybody that owns an apartment, I think, is got their minds wrapped around this. I think it's still 27 and a half year straight line depreciation schedule on their building. And pairing that with what we've been talking about, that may be the extent of what they think about on their taxes for their building. Oh, the depreciation is the most important part. What are your thoughts? Well, give me, for somebody that knows nothing about it, and I don't claim to know much more than nothing, but just a little more, about what cost segregation can do for somebody's depreciation on an apartment building.
Sure. So with residential property, the lifespan of residential building property, not land, but the building itself, is 27 and a half years. With commercial, it's 39 years. So essentially the way that works is if you have a $1 million property, and let's say that it's a single family residence, 60% is building, 40% is land, 60% of $1 million, so 600,000, which would be the allocated value to the building. You get what I call a phantom expense on your return, known as depreciation, where you take the $600,000 valued building and you divide it over 27.5 years. I consider depreciation to be one of the better things built into the Internal Revenue Code, even though at the end of the asset's life, if you don't do a 1031 exchange, there's some tax implications that are involved with recapturing that benefit if you ever outright sell the property. But in the immediate year of ownership, you get this phantom deduction against your rental income, which is known as the depreciation write-off. I've been doing this 17 years, so cost segregation has been not a very popular topic, but especially with my clients who have large real estate investment portfolios, that has been a common conversation and even a common election or filing on a year-to-year basis for those clients. For people just getting into real estate, it's usually not at the forefront of their mind. It's not a conversation because they're entering into their first big deal, and that's stressful enough. But if the numbers make sense, the way that cost segregation works is it allows you to reach into future years and grab future phantom costs, future phantom depreciation, and capture it in the current year in hopes for increasing cash flow. Meaning that if my property, let's say, has been owned for 10 or 15 years, but I've dumped a ton of money into the property. So my depreciable basis, let's say, is let's say $600,000. And through a cost segregation analysis with a third-party vendor, this is not something normally that your accountant will do for you. I don't think accountants normally do it at all for anybody, because there's special companies out there that can make these elections for you and file the paperwork. But essentially what this election means is that you take a look at the property itself as it stands now, and this company will come in and they will analyze the carry forward depreciation amount that hasn't been taken yet. Now, it's not going to be all 100% accelerated on your return, but let's say that you've got 400 grand in leftover depreciation over the next, 15 years. What this election will allow you to do is reach forward into those future years and take future deductions, but on the current year tax return. And if your property is cash flowing 20, 30, 40, 50 plus grand a year, and you're always asking the question of your tax preparer, hey, how can I reduce this liability? I've done all of the improvements. My tenant really just doesn't call me that much. I don't have to fix very many things. So I'm just cash flowing like crazy. I have very low debt on the property. You're looking for these added benefit write-offs. And a cost segregation analysis is one of those things that will allow this cash flowing property to take future deductions in the current year. Now, some people will argue with and say that, well, what happens if I sell the property 3 years from now? I'll have to recapture all of that benefit. Well, absolutely. That depreciation is a great thing while you own the property, but if you don't exchange the property, if you outright sell it, every single year of depreciation that you've taken in the year of sale has to be recaptured, meaning it has to be added up and added back as ordinary income on your individual return. And that is what really creates the feeding frenzy around the 1031 exchange industry, is that people, one, they don't want to pay the capital gain tax, and two, because their properties are either fully depreciated or have accumulated a lot of depreciation over the years of ownership, they don't want to pay the capital gain tax plus the ordinary income tax on all of that depreciation they have to add back. That's the cost segregation allows you to reach forward into future years and take deductions now to increase cash flow, to put more money back in your pocket, but only if it makes sense. That's why when people do cost segregation, filings or elections, they need to see the numbers first before actually moving forward with it. Because if it costs you just as much as it's going to save you, or really not that much in savings compared to what it's costing you, it might not be worth it, especially if your plan was always to sell the property outright in retirement in the next 3, 4, 5 years.
Right,
but one thing that I did want to mention before we move on is that under the CARES Act, the bill that passed during the pandemic, the federal government included something under the CARES Act called QIP, QIP. And QIP, a part of the Internal Revenue Code, allows qualified improvement property to be accelerated outside of a cost segregation analysis. Now, most qualified improvement property is any interior improvement, and mostly to non-residential properties, unless those residential properties are for hospitality use, venue space. I know that a lot of my clients who own wedding venue spaces and really unique properties across California, they've been able to do that as well. So you have to make sure that your property qualifies for it, but qualified improvement property is cost segregation, but essentially for free. And you can actually go back and amend 2018, 2019, and 2020 returns to take advantage of qualified improvement property acceleration without having to go through the full-blown cost segregation analysis. And it essentially achieves the same goal. It's a matter of taking accelerated bonus depreciation on the return rather than having to spread it out over the lifespan of the asset, which could be 27 and a half years for residential or even 39 years for commercial.
Really interesting stuff. I mean, obviously, this is just another example of something that most of us didn't know about. If you have a characteristic or qualifying property type, it would, excellent knowledge. Let's leave it there. What I want to do is I want to make sure anybody listening to this knows how to get a hold of you. Why don't you throw out your website and just your whatever, however the easiest way, and also put the same exact thing you tell me in the show notes, because I think at the end of the day, like we talked about earlier, a lot of us just sort of, this is a phase of their year where they think about tax, but as you go along and you get a bigger asset base and you get a higher income coming in, they're after you, right? They're going to want more of that. And it's a guy like Tony here that can show you how to, mitigate that. What's the best way to get a hold of you, like through email or phone or whatever you like?
Sure. The best way to get in contact with myself or anyone at my firm is, I mean, you can check out our website. I'll give you that first, www.roberthalltaxes.com. And our website is a great tool, by the way. We've got a lot of links and a lot of forms that you can download to help understand more things about what could be a write-off for your rental property, what could be a write-off for your business. So once again, www.roberthalltaxes.com. If you would like to sign up or submit information for a free consultation, just shoot an email. My full name, Tony Watson at roberthalltaxes.com. Shoot an email to TonyWatson, Tony Watson at roberthalltaxes.com. And you just say, hey, I'd like to take you up on that free consultation. We'll get you set up on the calendar. And that's 30 minutes. Either in person or over the phone. Our office should be fully back up and running in the next couple of weeks for in-person appointments. So thank goodness we had to pass, I think, a colored tier here in Los Angeles to open back up, because on any given day, our office could pump out, 60, minimum 60 to upwards of 100 warm bodies out of our office every single day. So LA was pumping the brakes on our reopening date, but that should be happening in the next week, maybe 2 or 3 weeks. So most of those free consultations can be done by phone, can be done by Skype or Zoom, whatever you feel comfortable with. And don't think that you're getting less quality by doing it digitally. It just saves you the time and hassle of having to sit in the traffic that seems to be back here in Los Angeles.
Oh, it's back. Yeah, it's back. So. And I think most people have got pretty hip to the Zoom or the online interface, more so obviously than if we didn't have that. So, and I'll certainly replicate that in the show notes. I'm also going to put that New York Times article about the 1031 exchange for anybody that wants to read it. But really interesting stuff, right? Stuff that is really important that can maybe get swept to the side a little bit, which shouldn't be swept to the side. And it was really a pleasure having you on here today, Tony.
You as well, Eric. Thank you so much. Really appreciate you having me. And I look forward to coming back soon. Once the Biden administration finalizes the code, have me back and I'll dial in all of those specifics for everyone.
I think that sounds like a great plan, and we'll definitely figure that one out. And hope you have a great rest of your day. Thanks again for coming. Thank you all for listening to the Everything Apartments podcast. I'm your host, Eric Christopher. Stay tuned for another episode soon.